Welcome to episode 2 of the Discovery Invest series on how to navigate the world of global investing. I'm your host Jennifer Arendse, and with me today I've got Craig Scher, Head of R&D of Discovery Invest. And for those of you who don't know, it's Head of Research and Development of Discovery Invest. Big title. Craig is a qualified actuary, and he's been with us for over 19, almost 19 years this year, right, Craig?
That's right.
Experience in life, investments, and employee benefits, so a very broad spectrum of investing. So we look forward to hearing all your insights you're going to share with listeners today. So Craig will be talking to us today about what he terms the risk paradox. And I think that's quite an important concept for investors to understand. So our conversation today will really be about how do you make and how do you get the rewarding part of offshore investing, yet understand the complexity and the risk part of it. Craig, which leads me into the first question here really today. And I think generally investors are really wary about offshore investing, and they see it as quite a risky endeavour. So perhaps we start off today with two concepts, and maybe it's in a general context, but it applies to offshore investing as well. Talk to us about risk and reward from an investment perspective.
Thanks, Jen. So risk and reward is really, those are the terms that we always talk about in investing. Risk, we tend to think about as the chances of losing money when we invest, and reward is really the chance of getting money, of earning more returns. And we tend to think of the two concepts are high risk, high return, and low risk, low return. And we tend to think of it over a short investment period. So for example, if you were to put your money in cash or money market instruments, those are typically low risk investments, but you don't expect much of a return out of them. They'll hold your money, you won't get much of a return, but at least it'll be safe over the short term. On the other side of the coin, I guess there's high risk investing, and we tend to think of things like equities, shares, and global equities. And those are investments that will expect higher returns over the long term, but you also have a chance of losing money in the short term. So low risk, low return is cash and money market instruments, and high risk, high return is equity and shares. Compounding on top of this is the idea of global equity, and there you don't only just have high risk, high return, but you also have the possibility of currency movements, and so the returns are amplified on the upside and the downside.
That's interesting. So you're saying you get compensated for the higher risk you take. So higher risk, higher reward, that's true.
Correct.
Okay, so can you explain to us why? Why does that relationship exist between higher risk and being rewarded for that? So that investors can understand whether it's actually something they should entertain.
Well, I mean, the key really for an investor is to identify where their risk actually lies. Over the short term, it's certainly true that low risk, low return is cash and money market, but over the long term, you actually see a very interesting thing start happening. And there's, I think, the paradox. Over the longer term, things like money market instruments, things like cash, although they will be stable, over the long term, you actually won't get out much from them. They'll expect to actually underperform inflation. They're expected to not give you much of a return. And in fact, when you push out your investment time horizon, they actually become a pretty poor investment. And I'd call them actually very high risk over the long term. Converse to that is you actually see equities, shares and global equities, and they, over the long term, actually become a safer place to put your money. So although in the short term they may be more risky, over the long term, those are actually the places that are expected to outperform inflation. They're expected to keep up with your cost of living. Very unlikely that they will lose capital over a long investment period. And so you see that low risk is actually shares and equities over the long term, and high risk actually becomes cash and money market instruments. And that's the paradox.
It sounds all paradoxical. It goes against all conventional beliefs or what we as investors believe from an emotional perspective when we look at our appetite for risk. When you find that most investors, who are adverse to risk, would rather just go for the safety of what cash offers. But what you are actually telling us that given enough time, you're actually embarking on a more risky investment. Although you won't see the fluctuations in your money, you won't reach your ultimate outcome over the longer term if you invest in cash.
Correct, Jen. I mean, you've highlighted something very, very important there, and that's investor behavior. And what investors do is they tend to invest for the long term. They know they have a long-term time horizon, 15 years, 20 years, etc. And so they put their money into the right investment vehicle. They may be investing in shares and global equities over that long term. But then what happens is market volatility. And we all know through the COVID crisis, the markets fell, they collapsed, there was a lot of volatility in there. And people get really scared. And then what happens is they pull their money out of equities and global equities and shares, and they put their money into cash and money market instruments. And their thinking is that they're protecting their money, right? The problem is timing. See, what happens is the market falls, they realize that it's risky, and then they pull their money out of equity, put it into cash. Then the market recovers, there's like sort of this V shape, it comes back very nicely. And then they realize that the market's back up again, and so they should put their money back into shares at that point in time. The problem is that they've now experienced the entire fall and they haven't participated in any of the recovery. And we actually saw, if you measure over the last 2 years, that about 40 billion in assets moved out of equities into cash during the COVID crisis. And some of it came back, but it came back at the wrong time. And so investors locked in their losses. And that's really because of this paradox. They thought they were being less risky by moving into cash, but in fact, they decimated a lot of their long-term investment returns.
It all feels so counterintuitive though, because I can imagine at that time when you look at it, everything in you tells you that was your wealth you've created. It's all gone in front of you. And somebody tells you, just relax, it's a paper loss. How do we as investors and as listeners today protect ourselves against that knee-jerk reaction? Because nobody wants to lose out on the 10 best days of the market. Nobody wants to. But when you're faced with the decision, you have no choice. You have this constant fight in your brain where your limbic brain says, do it now, you can't do it. And your prefrontal, your long-term brain with things rationally says, relax. And that's probably your advisor's voice. But we know the limbic brain wins most of the time. Give us some tips, Craig. Help us be rational.
It's a very difficult thing. In fact, you need a lot of courage. And the key, I think, is that to look back historically. And we always tend to say, this time it's different. The market fell this time it's different. This time the market won't recover. But the reality is that every time the market fell, we thought this time is different. And it never really was. The market recovers afterwards. Even something like the financial crisis, even something like COVID, if you look at it as a long-term investment, they're really just blips. They are small little falls in the market, but they always recover. It always comes back. And so the thinking is you need a lot of courage. You need to actually pull yourself back. And the right investment decision is actually to, when the market falls, is not to pull your money out, but in fact to invest more, to keep investing more, to keep your recurring investments going.
So in fact, you must do the complete opposite, do more.
Exactly right. You do exactly the opposite as what you're thinking, and that's actually the right way to invest. You must remember that the markets don't care about what you think. The markets will do what they do. So you have to play their game.
Sure. So the way to know you're on the right track is when you do the opposite. When there's volatility, just do the opposite and forget about how you feel.
Yeah, I'm not sure about always the opposite, but the point is to do the rational thing.
Do the rational thing.
Do the rational thing always.
Yeah. And I guess that's why we say to clients all the time is this is a journey best embarked on with a financial advisor, a skilled financial advisor, to make sure that when you go through those times, you don't just have your own voice. You have a rational voice with you to help you make the informed and the right decisions.
Absolutely.
Thank you, Craig. And I think that was quite insightful. My big takeout is when everybody panics, relax. Only make decisions when you are able to take a bird's eye view on things. And I suppose that applies to everything in life. Take a bird's eye view on things, and it applies to investing too. Craig, so we spoke quite a bit about higher risk, higher reward, long-term, short-term investing. Cash is more suitable as a short-term investment option. Stocks, equities, more longer-term, and we spoke about the associated risk that applies there. Now, all of this applies from an offshore investing context, and I know at the moment many investors are asking when, how, should I go offshore? Can you bring that all together for us from an offshore investing context? Maybe starting with what are the benefits, firstly, of investing offshore, and how do investors then navigate this higher risk, higher reward scenario that represents itself in the offshore space?
Sure. So offshore investing really is key and critical to any long-term investment strategy. It is a long-term strategy to invest your money offshore. And one of the key important factors here is that a lot of what we buy today is exposed to rand dollar depreciation. We import a lot from overseas. The car that you drove here in, your cell phone, all of that is exposed to rand dollar fluctuations. And so your investments need to keep track with that because your retirement is also going to be exposed to that. Also very important is that investing offshore is really a very good diversification tactic and something that you need to do. We need to remember that the South African economy is really only about 1% of the world economy, and you would never invest everything you have only in 1% of the global market. So you need to diversify, get your money out to different countries, exposed to different countries, different sovereigns, different credit risks, all those type of things.
Like show your money the world, right?
Show your money the world, exactly. Also importantly is to diversify by currency. To have all your money in rands is one thing, but you also want to get exposure to hard currency, to dollars, to euros, to pounds, and your money to keep track with rand dollar depreciation or appreciation where it happens. We also have to bear in mind that South African shares don't always have exposure to a lot of things that are available overseas. Shares like technology, like healthcare, all those type of things. There aren't many stocks on the stock exchange that can actually get you exposure to these type of investments, and they are often the ones that are doing really, really well, and that's where the market and where the world is headed.
And we talk about these 4 mega trends, right, that you want exposure to, but you don't really get it locally.
Correct. So a lot of them you don't get locally, and I think it's very important, I guess, to highlight those trends. There are lots of trends, investment trends around the world. The 4 that we've focused on that are really driving a lot of growth and a lot of excitement in the world and the investment world are things like millennial spending. So where people that are earning now are going to be spending their money, and you want to invest in those companies or those shares where people are buying, which is very, very important. The second is technology. We all know about technology, and investing your money in tech shares is definitely a place of a lot of growth. ESG and green. I mean, a lot of companies are focused on the environment, and that's a huge source of growth in the world today, in the investment world. And so those shares are primed for growth. And the fourth, which is really important, is healthcare. And we know a lot about that through COVID, and how many companies are focused on growing out healthcare and making it available to the world. A lot of these shares are not available on the South African Stock Exchange. And so investing globally will give you access to these mega trends.
Diversification through accessibility, or enhanced through accessibility essentially nowadays. It's been there, but now it's just so much more accessible as an individual investor and not just for institutional investors anymore. So great opportunities for investors to capitalize on from offshore investment markets. So if you can give us a few guidelines and tips, Craig, in terms of when you go into offshore investing. So now we think this is a risky endeavor. How do you mitigate that risk? How do you make sure that you don't take on undue risk? We hear a lot about, jurisdictions, about CITES, about all those other things you need to worry about when you get to offshore investing. But we still feel this is a more risky endeavor. How do we give ourselves peace of mind that it's not?
Correct. So interestingly, there are a lot of structures in South Africa to get your money offshore. Some of them are more complicated than others, and I guess that's why we tend to think of it as risky. The reality is that actually it's not like that at all.
Counterintuitive.
Again, counterintuitive. If you had a financial advisor, there's a structure in South Africa called a global endowment. It is incredibly simple. You fill out an application form. Your money goes offshore into a set of funds. All your tax is taken care of. All your estate planning is taken care of. You have access to your money whenever you need it. Really, really a simple investment mechanism. And you can, once your money is offshore, you can transfer it anywhere in the world, or you can bring it back to South Africa if you want. So it's really much simpler than people would think.
If you choose the right assistance And if you choose the right solution, you can remove all the complexity and only benefit from the reward.
Okay.
And then when markets happen, we sit tight, we hold tight, we go bird's eye view, relax, nothing to panic about. That's 3 simple steps.
Perfect.
Sounds good. I think even I can do it. Thank you, everyone. And that was Craig Scher, Head of Discovery Research and Development at Discovery Invest. Thanks for coming in and sharing your insights with us today. In the meantime, you can head over to our offshore info hub on www.discovery.co.za. Here you'll find a host of reader-friendly resources that will help you understand the fundamentals of investing offshore. Our next episode, please don't miss it. We are interviewing special guests from world leaders in global investing, BlackRock.